So here we go. Now we're ready to go. We have got the Pilla Tax Academy show for you this week with our incredible speaker, Mr. Dan Pilla. Dan, we're excited. We got a great show ready for everybody to go. There's a lot of great things coming out, a lot of great content. So I know you and I have been talking about a lot about the PPP loans, but now we're getting into 2021. You've got a ton of taxpayers out there. And, you know, like the flyer said, Dan, you talked about last year, the IRS issued 40 million penalties. So that's a big deal for the everyday taxpayer, because probably many of those went out to small business owners, everyday taxpayers that had no clue. So maybe let's just jump right in, Dan, and let's hit them strong with some great information that can help a lot of people.
Yeah, Jay, let me set the table here. We're talking about 40 million. Actually, it's north of 40 million. It's almost 41 million penalties against individuals and businesses, Jay. Now, put this into context here. There's only about 152, 153 million individual tax returns filed. So 40 million penalties against that many. I mean, we're talking about a very significant percentage of people out there that get hit with penalties. Now, in fairness, a lot of those penalties are assessed against small businesses, just like you say. And so small businesses need to know what we're talking about tonight. Now, here's what I want to drill into tonight, Jay. 75% of those penalties, about 30 million of those penalties, just a little south of 30 million, are assessed for failure to pay the taxes. All right. So this is a huge problem in America, people not being able to pay their taxes on time. So I want to talk about a couple of things tonight that are going to help people get on top of that. It's going to show you how to avoid some of these problems in the first place. A lot of people, Jay, get blindsided with what's called the failure to deposit penalty. About 10 million of those 43 million of those 40 million penalties are assessed for failure to make proper deposits. Now, you could pay your taxes in full and still get hit with a penalty for not depositing the taxes on time. And we can talk about what that means and what that looks like and how to avoid it. But I'm telling you, Jay, this is a huge problem. So you folks that are dialed in with us tonight, take some notes, get your notepads out, write some of this stuff down. And we're gonna show you how to stay out of trouble here in a major problem area.
You know, Dan, how come so many people are getting, hit with these failure to pay penalties? Where's that coming from?
Well, it's coming from two places, Jay. I touched on the one, failure to make deposits, but let's talk about the main failure to file penalty. Almost 20 million of the 40 million penalties are for failure to pay the tax. So what happens is if you don't pay your taxes in full and on time, if those tax payments are late, then the IRS assesses a penalty equal to 1% a month for every part of a month that the tax is paid late, for a maximum of 25 months or 25%. And then plus the interest goes on top of that, right? So now you owe the tax, the penalties, and the interest. And the interest gets compounded daily on the entire unpaid balance of tax, penalty, and previously assessed interest, because it's compounded every day. And so what happens is the typical delinquent tax bill is increased by almost 300%. The Government Accountability Office did a study once and showed that the IRS typical delinquent tax debt increases by about 280%, Jay, as a result of these penalties. And so it's a huge problem. So now here's the thing. You got to pay the tax in full by April the 15th. Now here's what blindsides a lot of people. The responsibility to pay the tax is tied to that April 15th deadline. All right. So here we are in 2021. We're going to be filing our 2020 tax returns here in the next couple of months. Your 2020 tax payment is effectively due by April 15th of 2021. Even if you get an extension of time to file the return, Jay, you still have to pay the tax by April 15th. The extension of time to file a tax return is not an extension of time to pay the tax. And that's what fools a lot of people. They think an extension is an extension is an extension, and it's not. All right. So that's one reason that people get blindsided. Another reason is with respect to these deposit penalties. As I said, about 10 million of these penalties are failure to deposit the taxes. Now, you've got a responsibility to pay your taxes as you earn the income. All right. So your tax liability, even though it's ultimately supposed to be paid by April 15th, you've got a responsibility to make installment payments on that tax liability over the course of the year. All right, so here's how this works. Wage earners have withholding taken out of their paychecks every month. That withholding amounts to an estimated tax payment. As the income is earned, the taxes are withheld, the estimated payment is therefore made. Self-employed people don't have that luxury, Jay. They got to make the payments themselves. And this is where self-employed people get themselves in trouble. They've got to make the payments on a quarterly basis. At least, I say you got to look at your situation monthly, but at least quarterly, you got to look at your situation and figure out what your estimated tax liability is and make that payment on a quarterly basis. Well, self-employed people don't have the luxury of wage withholding. And a lot of self-employed people they just don't sit down and do the computations that are necessary to figure out what their withholding taxes are. And so they start thinking about their tax liability, on April 1st, and then they get their tax return back from their accountant, and lo and behold, they owe $12,000 or $15,000 or $8,000 or $10,000 or $20,000 or whatever the number is. And now they got to try to come up with the entire lump sum by April 15th. Of course, that's difficult to do. And so that's how they get themselves into trouble. So we want to talk about the wage withholding situation. We want to talk about these estimated payments and get people dialed in to how this really works.
Well, how much should people, like, for example, estimate? This is great information, by the way. What should people plan on? If you're self-employed, you got a small business, you're talking about preferably look at that monthly, no later than quarterly. Well, how much should they kind of be looking at there, Dan?
Yeah, that's a good question. What's the magic number? Well, the answer is there is no magic number. It's based on your specific facts and circumstances. But let me tell you how the IRS looks at the formula as far as avoiding the penalty. It's called the 90%, 100% rule. And here's what it means. Now, let's take 2021 as our target now, right? Because we're in tax year 2021. The income you earn now going forward until December 31st is taxed in 2021. Tax year 2020 is now a dead letter. You're going to file your tax return in a couple of months, but that year is past now. The calendar's rolled over. So let's talk about 2021. You've got a responsibility to pay either 90% of the current year's taxes. So the current year's taxes would be the tax owed for 2021, or 100% of the tax owed for the previous year, which would be 2020. Whichever's less. All right. So here's important to understand. You have no responsibility to overpay your taxes. We'll talk about tax refunds in a minute here, Jay, as we move on. But millions of people overpay their taxes every year. They think they're doing themselves a favor. They're not. We'll talk about that. So here's how the 90%, 100% rule works. All right. So let's say your 2020 tax liability was $5,000. All right. So going into 2021, you have a responsibility to pay at least $5,000, or if your income is down in 2021, or you project that it will be down, you have to pay 90% of the projected 2021 tax liability. So let me give you an example now. Here we are in 2021. You think as a taxpayer, small business person, wage earner, whatever the situation is, you believe that your circumstances are going to be about the same in 2021 as they were in 2020. Well, if your tax liability was $5,000 in 2020, now, of course, you got to prepare your 2020 tax return to know exactly what your tax liability is. So the sooner you get that done, the better. But let's just use that $5,000 number as an example. You think your circumstances are going to be about the same in 2021 as they are in 2020. Okay, if that's the case, then $5,000 becomes your target estimated payment amount during the course of 2021. If you're a self-employed person, that means you got to pay about $1,250 a quarter in order to cover that tax liability throughout the course of the year. Now you say, well, okay, that's fine. My circumstances have changed. Okay, let's address the changed circumstances. Is your income going to be down 20 or 25%? Let's just say I'm a self-employed person and I lost a contract and I know that's going to cost me 20% of my income. Well, if 20% of your income is gone, approximately 20% of your tax liability is gone. So now you don't have to overpay your tax, Jay. We already said that. So now you use the 90% rule. All right. So if you think your income is down by 20%, now your target is more like $4,000 instead of $5,000. The other side of the coin is, all right, we got a new big contract and I think the income is going to be up by 20%. Okay, fine. Now we add 20% to the $5,000 number. Now your target's about $6,000. You see, this is an estimate, Jay. It's important to understand that this is an estimate. But if you come in with that 90%, if you fall into that 90%, 100% window, you're going to avoid the penalties for failure to deposit. And you will also avoid the penalties for failure to pay because your tax will be essentially paid by the time you file your 2021 tax return, basically a year from now. So that's the target number you need to look at. Now, small business people, Jay, have a unique problem because it's always a moving target.
Right.
Wage earners are generally pretty much settled in unless they've changed jobs or they get a significant raise or a significant decrease in their income. But generally speaking, wage earners are fairly static from month to month throughout the course of the year. That's not true of small business people, Jay. It's up and down and up and down. My dad used to say, when you're self-employed, 1 month you eat the chicken and the next month you eat the feathers, right? Because your income is up and down and it fluctuates so much. All right, that's fine. But remember, you just keep in mind that we're due because it's a moving target. You're going to be evaluating your circumstances on at least a quarterly basis. So small business people, Jay, need to understand how to compute a very simple but accurate profit and loss statement. The profit and loss statement is just simply a statement of your total business gross receipts. All the money you've earned before paying a nickel's worth of expenses is your gross receipts. And then itemize your expenses by category. So we've got our gross receipts minus our expenses is net income. Your tax liability, of course, is based on net business income, not gross income. So if you're doing that profit and loss statement accurately on an ongoing basis, at least quarterly, you're going to have your finger on the pulse of the tax liability. And then the next step, and this is the hard part, it's easy enough to keep the records, right? The hard part is paying the tax. So as a self-employed person, you simply must get yourself into the habit of setting aside a portion of your income so that you've got the capacity to make these estimated payments when they become due. You can't just, look at your situation and say, oh, we got 10 grand in the mail this month. This is great. And now you spend all the money. You've got to segregate a portion of that money so that you can make those deposits on an ongoing basis. Now, this is where CPA becomes very helpful, Jay. They can sit down, get that record keeping system set up. If you don't already have one, show you how to make a profit and loss statement. Of course, I can do that too. It's a very simple process, but the key is to keep the records and make the statement accurately. And then number two, as I said, take the money, set it aside and pay it into the IRS.
Now, you mentioned refunds. How does refunds play into this, Dan?
Well, millions of people get refunds every year, Jay. I mean, there are a significant number of people that get refunds. It's in the tens of millions. And the average refund, this is for tax year 2019, refunds paid in 2020, Jay. The typical person, let me rephrase that and say the average refund was almost $3,500. So what that means is if you are the average person, you got the average refund of $3,500. That means you paid about $300 a month into the IRS month in and month out in taxes that you don't owe. All right. This is a critical mistake, Jay, because the IRS is holding your money for more than a year. When you get your refund, it's always 14 or 15 months after you started paying them in, right? You're paying from January through December, but then you don't file your tax return until March or April. So it's 14 or 15 months worth of payments that you're making into the IRS by the time you get that refund back. So they're always ahead of the game when it comes to holding your money that you don't owe. All right. So what can you do with $300 a month, Jay? For a lot of people, that's a car payment, right?
That's right. Right. That's
Maybe it's an insurance policy. Maybe it's how you fund your IRA or your 401k. $300 a month goes a long way to funding an IRA or a 401k, especially if you're a young person, 30 or 40 years old. All right. It's the world's worst way to save money. People tell me all the time, well, Dan, it's a good way for me to save money because, then the IRS said it's the world's worst way to save money because they're not paying you interest on the money. If you take that same $300 a month and put it into your IRA or your 401k, not only do you get the benefit of the growth, you get the benefit of the interest, you get a tax deduction for it, Jay. You get a tax deduction on your return for IRA or 401k contributions under certain circumstances. So you got to pay attention to that. The reason this happens, Jay, is people don't understand the W-4 form. And so let's take a few minutes and talk about the W-4 form.
Important. Yes.
Yeah. So the W-4 form is called the Employees Withholding Certificate. All right. The responsibility to withhold. Now, this is for employees now, W-2 wage earners, right? People that are getting a paycheck from a company. Self-employed people do not use the W-4 form. They use that estimated payment system that I talked about a minute ago. But for employees, and of course, the vast majority of people in our country, about 85% of all tax return filers are W-2 wage earners, all right? So this applies to about 85% of the people across the board here. What happens is your employer withholds taxes from your paycheck based on the W-4 information that you provide to the employer. All right. The employee's withholding certificate, the form W-4, you as the employee fill out, you submit it to the employer withholds on the basis of that information. Here's what happens, Jay. Here's the mistake people make. They get a new job. They file a W-4 form and then they forget about it. All right. They look at the W-4 as if it's a file and forget paper, and it's not. All right. Your W-4 form needs to be a living document. You need to adjust your withholding based on life-changing circumstances. All right. For example, if you got married or divorced during the course of the tax year, that's a significant change that has an impact on your tax liability. If you had a baby or one of your dependent children left the home, right? They grew up and moved out. Those are life-changing tax consequences to those circumstances. If you start a new IRA or you start taking distributions from an existing IRA, if you start a business or close a business, if you bought a house or sold a house, all of these things come into play, Jay, for purposes of determining your withholding, because you, as I said, I'm going to say this again, I'll say it 20 times. You don't have a responsibility to pay to the IRS more money than you owe. So when you have changes in your circumstances that affect your lifestyle or that affect your life and are going to have a consequence on your taxes, which is just about anything, by the way, which is one of the nefarious things about our income tax, which is a different, another subject for a different day. But the thing is, when you have one of these life-changing circumstances, all right, you need to make an adjustment to your withholding. Now, here's what you want to do. A lot of people say, well, Dan, you tell me it's not a good idea to get a refund, and so I should adjust my withholding, but I don't want a big tax liability either. Okay, well, that's true. You don't want to over withhold and get a refund because that's bad business. You certainly don't want to owe the IRS money because now you face penalties. But those aren't the only two options, Jay. There's a third option. And the third option is that you pay sufficient money to the IRS to cover your tax liability, but you don't overpay. In other words, you get yourself as close to net zero through the withholding process as you possibly can. That is to say, you pay in enough to cover your tax liability, but not to create a substantial refund. And that's done by adjusting your withholding. So the key is to adjust the withholding to match the tax liability. So if you were one of those people that got a $3,500 refund, tweak your withholding so a little bit less money is taken out of your paycheck every month. All right. Get that tax refund in your paycheck every month, $300 a month, month in and month out, tax free. It's like working overtime, Jay, only you don't have to work overtime. Right. That's what's going on here. Now you say, well, how do I do that? All right. The IRS has an estimator on its website, irs.gov, irs.gov. And then in the search box, you just put in withholding estimator. And it's got a little worksheet in there that's pretty simple that walks you through the process of figuring out your withholding. And it takes into consideration whether you got two jobs or whether you're working a wage job and you got a self-employed job on the side, or you just strictly have wage income. All of these things are factored in and it walks you through the withholding. Takes into account your deductions, Jace, because here's the thing that people overlook. Your withholding is based on your tax liability. And if you've got itemized deductions like mortgage interest and real estate taxes and charitable contributions, or maybe even business losses, those things reduce your tax liability. They have the impact of lowering your tax liability. So those things have to be taken into consideration for figuring with your wage withholding. The single biggest mistake people make in figuring wage withholding, Jay, is they only think in terms of themselves and their dependents. All right, I've got myself, I've got my spouse, we got 2 kids. All right, that's how I figure my withholding based on those dependents. No, no, no. That's part of it, but that's not all of it. The next step you have to go to is factoring in your deductions that reduce your tax liability, because you're allowed to compute withholding based on any item that's going to have the impact of reducing your tax liability. That's how you get your withholding to the point where you're not overpaying the IRS, but you're not significantly underpaying them either. So that when you file your tax return, by the time the year is over with, you don't owe the IRS any money. They don't owe you any money. Now, look at Jay. This is not an exact science. You're not going to get exactly to the dollar where you're zeroed out. But if you've got a situation where you owe them a couple, $300, $400, $500, or they owe you $300 or $400 or $500, you've done a pretty doggone good job of adjusting your withholding. Same with self-employed people. Through the estimated payment system, you're not going to get to the bottom line dollar. Never. But if you're in a situation where you've made enough estimated payments to cover that 90% or 100% rule, you're golden, man. You're not going to get hit with the penalties.
This is awesome. You just spoke of penalties. I know everybody's got to be asking this question now. What must we do to avoid getting hit with any penalties? People don't want penalties. How do we stay out of that mess?
Well, yeah, and this is the calculation process that I talked about, is using that 90%, 100% rule. You got to dial into that. That's the key thing. If you're using that 90%, 100% rule that I talked about, remember, it's 100% of last year's tax liability or 90% of this year's tax liability, whichever is less. All right, then you avoid the penalty for failure to make deposits and for failure to pay the tax. Now, so let's dial into that, Jay, for both a self-employed person and a wage earner. Get on the IRS's website for a wage earner. Use that estimator. Figure out carefully what your withholding needs to be. If you're a self-employed person, get into that situation like I talked about, where you're doing that profit and loss statement on at least a quarterly basis. So you're dialing into these numbers. You got to have these numbers dialed in, Jay. Look at this. Is one of the problems with the income tax, all right, that we have. It has required everybody to be an accountant. The problem is self-employed people don't want to be accountants, right? They want to be engineers. They want to be architects. They want to be carpenters. They want to be doctors. They want to be lawyers. They want to, whatever it is they want to be. They want to create. They want to produce. They want to be out there in the marketplace, making the world a better place. They don't want to be an accountant. If they wanted to be an accountant, that's what they'd have gone to school to do. But the tax law puts these burdens on people. And Jay, if you don't carry the load, you get spanked with the penalties. So you got to pay attention to this stuff.
This is awesome. Now, our final point we want to talk about tonight is, before we do a little housekeeping, is what about these business owners? They have wage holding. What can they do, Dan?
Well, yeah, the business owners have to be dialed into that profit and loss statement, like we talked about, Jay. That's the key for small business owners. They need to focus on the profit and loss statement on an ongoing basis, and if you don't know how to do this, it's a simple process. I can walk you through it. Your accountant can walk you through it. It's not complicated. All right. You think, oh, this is all accounting. No. It's addition and subtraction. That's all it is. All right. So what you got to do is pay attention to your gross business income, all of the money that comes into the business before you pay a nickel's worth of your expenses. And then you classify your business expenses. All right. So if you've got $10,000 coming into the business in a given month, those are gross receipts. And now you had to pay out, let's say, $7,000 in business expenses, materials, supplies, subcontractors, gasoline, all of the costs of doing business come off the top, right? Those are business deductions. And now you're left with $3,000, and the $3,000 is what you're living on. So $10,000 gross receipts, $7,000 worth of business expenses nets you down to $3,000 net business income. That's what the tax is based on. And that's what you then have to calculate your estimated payment based on that $3,000. Now, again, This is a moving target for small businesses because you might make $3,000 net profit in 1 month and 33 grand net profit the next month. And the month after that, you might be down to 10 grand net profit. Depends what kind of a business you're in. But if for small businesses, it's always a moving target. This is why it's so vital to do this on an ongoing basis, at least quarterly. And I say more like monthly to get closer to the correct number so that when you file your tax return at the end of the year, 4 months into the 3.5 months into the following year, you're not blindsided by a tax liability. Jay, I cannot tell you how many clients I've dealt with over the years that say, well, Dan, I've got my tax return in front of me and I owe 20 grand. I had no idea. And I'll ask the question, did you produce profit and loss statements on an ongoing basis throughout the year? And the response I get, Jay, almost every time is, what's a profit and loss statement? So not only did they not make a profit and loss statement, not only did they not create one, they don't even know what one is. And this is not a criticism. I'm not taking shots at small business people or entrepreneurs. I love you people. You people are creators. You're innovators. You're the people that drive the marketplace. I love small business people, but they get clobbered, Jay, and this is the reason. So understand what this profit and loss statement is, understand how this works, and keep yourself out of trouble.
This is great. Now, we are doing this particular stream because we want to provide great content over on PillaTaxAcademy.com. Here's a blockbuster announcement. Tomorrow, we will be going live on all 3 of Dan's Powerhouse Mastery courses. 3 of his Powerhouse Mastery courses. So the Tax Defense Live, that mastery course for tax pros. So if you're a tax pro, you need to get over and grab that particular course. There's still a discount available. You can get it on the pre-order price. So get over there to PillaTaxAcademy.com and grab it if you are a tax pro. Now, if you are a small business owner, you own a business, it's crazy to me. It's like playing Russian roulette with the IRS holding a gun that's full of bullets up to your head if you don't have that tax mastery course for the business owner. So the business owner mastery course that Dan Pilla spends multiple hours in a setting on a virtual platform to where he's delivering to you masterful information about how you are able to be a master at taxes, something that you didn't get taught in school. We all know it. I'm a small business owner. Who taught us? No one. That's the issue. It's time for the nonsense to stop. We got to get educated. And the best in America, Dan Pilla's here to do it. Then you got the everyday taxpayer who's probably paying way too much in taxes because they don't know what's available for them. They don't know their rights. So you've got the Taxpayer Rights Mastery course. You can go grab these courses. They're all going to be live tomorrow. So when we get going tomorrow, the staff has told me we're going to hit these things. It's going to be live. We're going. And you can grab these special prices right now. Now, here's a special announcement. If you're not on Clubhouse, you've got to get on Clubhouse. It's the hottest social media app in the world right now. It's got about 2 million users and about probably 1.5 million or more of those came in the last month or two onto the app. Why? Because it's a place where you can speak your voice. So I have convinced this powerhouse man, Dan Pilla, who knows more about taxes than even the IRS commissioner. I didn't say that. I think it was the Associated Press or Wall Street Journal once said that about Dan Pilla. So he's going live with me tomorrow, 6 p.m. Pacific Standard Time on Clubhouse. So you can follow me there at Jay Noland. You can follow Dan there now. Believe it or not, Dan is on at Dan Pilla. We got him on. There he is. He's on. And I believe Dan is going to absolutely crush it because who's all on Clubhouse now predominantly is the movers, the shakers, the thinkers, and tons of business owners, entrepreneurs, people who are probably getting clobbered and not talking about it. You think they're not going to want to hear from Dan tomorrow? So it's going to be a fired up room. We have a flyer that's going to hit the Pilla Tax Academy Facebook page. So make sure you check that out. It's going to hit the Instagram page. If you're not following By the way, you're missing a lot of free information if you're not following us on the Facebook page, which is the Pilla Tax Academy, and also on the Instagram. I love these Instagram posts that are going out pretty much every day with incredible tax information. Every day there's posts going out. So get over to Instagram.com/Pilla Tax Academy. And for goodness sake, if you're not on Clubhouse, get on Clubhouse. Now here's the caveat with Clubhouse. There's only one invite. So whoever you invite, make sure that's a great invite, because you might not get any more. You might if you're very, very, very productive on there. So I've been honored enough to get my own room within Clubhouse in one of the fastest period of times, because of what I've got going on as far as who we're talking to, who's connecting. I'm talking about all the who's who of thought leaders in the world are on Clubhouse. The number one tax thought leader in the United States of America is on Clubhouse, and we'll be talking at 6 p.m. tomorrow. Do not miss it. Figure out a way. Now, it's only available for people that have iPhones or Apple products. Now, that's a big one, because Dan says to me, Jay, I only got an Android. What do I do? We're like, Dan, you got to get an iPhone. And what do you do with that? You keep your same number, but you use the Wi-Fi on your iPhone or your iPad. People say, is that worth it? You better believe it. I'm telling you, it's that great of content that's going on there, and it's for free for the time being. And then it's going to get monetized. You watch what I'm telling you. So you heard it here first. Dan Pilla and I, 6 p.m. tomorrow, Pacific Standard Time. I don't know what kind of, I don't know, Dan, what do you think the title of the show should be? You know, it's going to be pretty ripping tomorrow.
Well, that's a good question, Jay. Maybe we should just feel our way through the first one and see what happens, huh?
Do we say this guy sued the IRS at 18 and 1? Come find out. Or do we say, do you think you will ever have a tax problem? If so, get over here. Or what about the 40 million penalties that went out last year?
Well, how about the 40 million penalties that went out last year? How about the 100 million computer notices that went out? How about the three, plus or minus 3 million third-party wage and bank levies and approximately 1 million tax liens? Jay, I mean, there's all kinds of problems that we can talk, all kinds of directions we can go in with this. People need help. People need help. This is, as far as I'm concerned, Jay, this is a national crisis. Tax compliance is a national crisis. We've got a tax code that consists of more than 4 million words that was changed more than 5,900 times just since 2001. And that doesn't count any of the hundreds of changes that occurred in 2020 with the various coronavirus bills that were passed, the relief acts that were passed, and just this last one, the Consolidated Appropriations Act that was signed December 27th, contains hundreds more tax law changes. Jay, we've been talking about this PPP stuff. There's much more to talk about. The pot is being stirred all the time by Congress. And I promise you, Jay, write this down. Within the next 100 days, let me put it this way. Within the first 100 days of the Biden presidency, we are going to see massive tax law changes again. Wow. So the ink is not dry on everything that happened in 2020, and all of that stuff is going to be changed going forward. You as a small business person, you have got to take steps to keep up with this stuff, because I'm telling you what, they're going straight for your pocketbook, and you need to keep your hand in the way, or they're going to get your money.
Wow, this is hot. This is great. Get on Clubhouse. Follow us tomorrow, 6 p.m. Pacific Standard Time. I promise you, you're going to hear some of the most thought-provoking, and it's going to be an open mic where we take questions. And I'm telling you, some of the top entrepreneurs in the world are going to be on there, plugging in, listening to Dan and I tomorrow, asking crazy questions. It's going to light Dan up to let him just burn. You guys got to be there. Dan's been another great show. I can't wait to talk to you again tomorrow. Thank you, everyone, for joining us. Spread this, share this. Everybody give a big thanks to Dan Pilla for what he did tonight. Make sure when you watch the replay of this, if you're on the podcast, you hear this, send us a message. Tell us you appreciate the information because it's valuable. Dan, we appreciate you. Catch you next time, everybody.
All right. Good night, everybody. Good night, Jay. God bless you all.